Guys, it's safe to say the economy and the stock market are on two different planets right now. You've got numerous stocks trading at all-time highs while unemployment is approaching all-time lows. The Nasdaq, the Dow Jones, the S&P are within touching distance of their all-time highs. Is it even possible to find any stocks that are undervalued in today's current market? I've found three, and by the end of this video, you will have a solid understanding of how to value and determine an undervalued stock. With that said, guys, let's go. What's going on, investors? My name's Emmanuel and welcome to my channel. We are living in such confusing times right now, guys. It's crazy. All you have to do is switch on CNBC and you've got one analyst saying March was the bottom and you should buy. And then you've got another analyst on an hour later saying there will be a second wave and you should wait for the second crash. You've got a lot of respected investors. They're all saying don't buy right now. You know, the market is too overvalued. You should sit in cash. There's just so much noise about the direction of the market. Frankly, guys, it's confusing. And I don't know about you guys, but when I feel confused from the noise, I tend to just switch off. So I started researching about past recessions and discovered this ain't new. This is nothing new. The exact same thing happened in the 08-09 financial crisis. That led to confusion. You had the dot-com bubble, which also led to confusion. 1987 Black Monday, 73, 74 stock market crash, and so on, all created confusion. And the biggest thing I learned from my research was that time in the market beats timing the market. Peter Lynch made an annual average return of 29% in the midst of three recessions. Peter Lynch was a massive advocate for finding stocks that are predictable over a 10 to 20 year period and then buying them when the stock was trading at its fair value, even in the midst of all-time highs. And that will be the foundation for today's video, guys. I will walk you through the exact metrics Peter Lynch used to determine a company's fair value. And in order for us to make a prediction of where the company or the business will be in 10 to 20 years time, we have to have an understanding of the company before we invest. So we will also be analyzing all three of these undervalued stocks today. But before we proceed, guys, smash the like button as it really helps my channel grow. Hit the subscribe button if you haven't already. We are on the road to 1K subs and we are halfway there, guys. I have so much valuable content on the way for you and it will be great to have you on board. And with that said, let's proceed with the video. Alright guys, we're going to kickstart this analysis with an excerpt from Peter Lynch's One Up on Wall Street. Link is in the description below, guys. Incredible book, you need to read it. He says, the PE ratio of any company that's fairly priced will equal its growth rate. I'm talking about the growth rate of earnings here. So this is how he describes what a fairly priced company should look like. And he gives us an example. He says, if the PE of Coca-Cola is 15, you would expect the company to be growing at about 15% a year. So remember, guys, he's referring to the year-on-year earnings growth. So if the PE of Coca-Cola is 15, you would expect the earnings growth year-on-year will be at 15%. But this is the key part. It says, but if the PE ratio is less than the growth rate, you may have found yourself a bargain. So if the PE ratio is less than the earnings year-on-year growth rate, you may have found yourself an undervalued stock. Okay, so this is his metrics for analyzing a company for it being fairly priced. And with that said, guys, we actually have a problem because majority of stocks have had negative earnings this first quarter of 2020, which of course is due to the global lockdown, business not being able to function. So with that metrics, we now have to rule out a lot of the airline stocks. Pretty much airline stocks is ruled out of this. So if you're expecting me to give a load of airline stocks, I apologize, guys. We can't include it in today's analysis because they just don't qualify. Again, cruise line stocks. Again, I've seen a lot of videos online, people talking about undervalued stocks. Cruise lines are being undervalued. How can you determine cruise line stocks as being undervalued if there's no earnings? Because you have to look to the earnings. Again, hotel stocks falls into this bracket. We've had to rule out hotel stocks. Restaurant stocks, again, they all have negative earnings for the first quarter due to global lockdown. Doesn't mean they're bad businesses. And even Disney, okay, we're going to have to rule out Disney. I love Disney, but guys, we can't determine a valuation. We can't put a valuation on Disney if there's no earnings, and so many more. Okay, guys, so with that metrics in place, the first stock that we have is eBay, ticker symbol EBAY. And as you can see here, guys, the PE ratio is sitting at 8.41 and it has an earnings per share of 5.72. And just for a recap, guys, the PE ratio means it's the price to earnings ratio. So that's a correlation between the market price and the earnings per share, okay? And the PE ratio pretty much determines how long you will get a return on your investment based at the current EPS. And to do the maths, all you have to do is you do 8.41 times the earnings per share, which will give you the market price, which is roughly about $48. Okay, so that's the PE ratio in a nutshell. And eBay's is at 8.41, the earnings per share is 5.72. And to find out the year-on-year earnings growth, you click on statistics on Yahoo Finance, scroll down to income statement, and right here you can see the quarterly earnings growth year-on-year for eBay is at 558.70%. That sounds, when I was doing my research, that looked a bit insane. But in order to double check this, you have to look at the income statement. So to go on the income statement, you click on financials. And now we're on the income statement on Yahoo Finance. If you click to quarterly, and remember, guys, all the numbers are in thousands. The first quarter of 2020 for eBay made a net income of 3.4 billion. Now, if you refer back to this first quarter of 2019, which is the 31st of March 2019, you can see their net income was 518 million. So from 518 million to 3.4 billion, that's a 550% return, which is incredible growth. So you have to bear in mind, eBay is one of those stocks that really benefited from the global lockdowns. Okay, all right, guys, so here we are. We've got eBay, a PE ratio of 8.41, and their quarterly earnings year-on-year growth is 558.70. So according to Peter Lynch, we have found ourselves an undervalued stock in eBay, and we found ourselves a bargain, essentially. So now let's look to eBay as a business. As I've mentioned before, guys, eBay is our first undervalued stock, ticker symbol EBAY. I'm going to find out the story for eBay. So they're one of the first e-commerce pioneers. eBay's been around for a very long time, and they were one of the first to do it. They're a consumer-to-consumer e-commerce marketplace. How do they generate their revenue? They generate their revenue through transaction fees and also marketing services that they offer to buyers and sellers. They also generate revenue from advertising, which is quite a popular revenue stream for a lot of tech stocks. And they also have classified platforms, including a collection of brands such as Gumtree. So Gumtree is quite popular in the UK. Mark Platts and others. All right, guys. So who are their main competition? Because it's important to understand the company's moats. Again, of course, no no arguments here. Amazon, you got Walmart online as well in America, big competitors. Shopify, you have Facebook Marketplace. These are all main competitors for eBay. And it wouldn't be doing it justice if we don't look at the risk factors surrounding eBay. So one of their biggest risks, I think, is their moat isn't wide enough. I'm not sure if they have a durable competitive advantage. And I put see annual reports. So let's go to the annual reports. And if you're wondering, guys, how to get to the annual report, all you have to do is go on Google, type in eBay Investors Relations, click on Investors Relations, and it will bring up all of its filings. So once you're on the Investor Relation tab, all you have to do is click on Financial Information. So once you're on the Financial Information tab, if you click on Annual Reports, and on here you have a history of all the annual reports, so 2019, 2018, 2017. So obviously we're going to look at the annual report for 2019. And on the annual report, guys, they've not really shied away from the fact that they're struggling with the competition. And on page 7 of the annual reports, I've highlighted this. It says we have increased competitive pressure online and offline, in particular with competitive norm 4 and the expected level of service from e-commerce and mobile commerce has significantly increased due to, among other factors, improved user experience, greater ease of buying goods, lower or no shipping costs, faster shipping times, and more favorable return policies. In addition, certain platform businesses such as Alibaba, Amazon, Apple, Facebook, and Google, many of whom are larger than us and have greater capitalizations. So again, they've really gone into detail with regards to their main concerns with their competitors being bigger companies than them. So that is a huge risk factor, guys. And lastly, guys, just a quick look at their balance sheet. They have a total cash position of 4.43 billion and total debt, which is sitting at 9 billion. So they do have a bit of debt on them. The current ratio, which I really like, is at 1.34. And also they have a nice operating cash flow, of course, at 3.16 billion. So to summarize, guys, I think eBay is quite undervalued right now, but I am concerned about their main competitors and that they haven't got a strong enough moat. All right, guys. So my next company that we're looking at is Johnson & Johnson, ticker symbol J&J. They have a PE ratio of 22.54. And their EPS is sitting at 6.41. Okay, we're going to look at the year-on-year quarterly earnings growth rate for Johnson & Johnson. And as you can see here, guys, it's sitting at 54.60%. So as you can see here, guys, I've summarized it. Their PE ratio is sitting at 22.54. And their quarterly earnings year-on-year is sitting at 54.60. So again, we found ourselves a bargain in Johnson & Johnson. Okay, guys, and a quick profile of Johnson & Johnson again. So they are the world's largest medical conglomerate, operating in over 60 countries. They've been established in 1886, so they've been around for a very long time. How do they generate their revenue? Through 3 different income streams. So first one is their consumer products, which again is the likes of Listerine, Sudafed, Benadryl, and so forth, and that makes 17% of their revenue. They also sell medical devices, surgical, orthopedics, endomechanical, hip and knee replacements, and that makes up 33% of their revenue. Also from their pharmaceuticals, so patented drugs, vaccines, so that takes up 50% of their revenue. And their main competitors, you have Pfizer, again, this well-known brand, Unilever, and you have Procter & Gamble as well, are also huge competitors for Johnson & Johnson. So on their annual report, they've mentioned their expansion plan, and their expansion plan is pretty much to patent more drugs, more vaccines, and to tackle more infectious diseases. They're also working on a vaccine for the current Rona virus, and that's how they're expanding at the moment. Again, we need to look at the risk factors surrounding Johnson & Johnson, and they've also mentioned their risk factors in their annual report, and they're talking about their supply chain issues is a bit of a problem right now. So on Johnson & Johnson annual report, you can see here their risks related to supply chain and operations, and they're pretty much detailed that they're having difficulties and delay in manufacturing internally through third-party providers and otherwise within the supply chain that may lead to voluntary or involuntary business interruptions or shutdowns, product shortages, withdrawals, and suspensions of products from the market, and potential regulatory action. So again, that's obviously going to affect the bottom line. So again, I would say they have a strong enough moat. Johnson & Johnson is a solid undervalued company. So another risk factor is drug pricing, especially if the Democrats win. They're very big on capping the prices of drugs for certain companies, so that could also affect the bottom line. But overall, guys, I think Johnson & Johnson is a solid undervalued company. I think they do have a strong competitive advantage and a strong moat, and they are trading at a bit of a bargain according to the metrics that Peter Lynch uses. Okay, taking a look at Johnson & Johnson's balance sheet, they have total cash of 18.02 billion. They do have a bit of debt, which is sitting at 27.58 billion. Their current ratio again is within range. It's above 1.31, and I like for the current ratio to be above 1, which indicates that they have a total current assets which is higher than the total current liabilities. Alright, guys, so the third stock that we have is Facebook, ticker symbol FB. and their PE ratio is 32.32. Earnings per share is sitting at 7.29. Looking at their quarterly earnings year-on-year growth, it's sitting at 101.80. And again, guys, just to summarize here, the PE ratio is 32.32, and the quarterly earnings year-on-year is 101.80. So again, another undervalued stock according to the Peter Lynch metrics. A quick profile of Facebook, guys. They develop products that enable people to connect and share with family and friends. Again, they use mobile devices, personal computers, and in-home devices worldwide. Their platforms that they use are Facebook, Facebook Messenger, Instagram, WhatsApp. These are all tools that we all probably have on our phone and use on a daily basis. And they also use Oculus, which is a VR device. And I didn't know that Facebook actually acquired Oculus until I was doing my research. So that was quite interesting to see. And how do Facebook generate their revenues? We all know this, guys. 98.5% is from advertising and 1.5% is from payments and fees. Their main competitors, of course, Google Ads. You have Amazon now, which are starting their own ad services, and also Microsoft as well. They also have an advertising platform that gives them great revenue. So this is quite strong competition, guys. They've also laid out their expansion plans, which Facebook is investing heavily to develop new products. And one of the main ones that we know or have heard of recently is their new liberal cryptocurrency. They're also tapping into AI and also augmented reality, which is really good, because if you look at their main risks that I've identified, it's the lack of diversification in their revenue stream. I mean, when you've got big dogs like Google, Amazon, and Microsoft on your heels and taking a lot of the market share of advertising, that's a huge worry for Facebook. So I do like the fact that they are expanding, and I do like the fact that they are looking into crypto, AI, and augmented reality. And lastly, guys, we're going to look at Facebook's balance sheet. They have a total cash of 60.29 billion. They pretty much have no debt, because their total debt is sitting at 10.81 billion. So they have more than enough cash to clear off their debt whenever they want to. Their current ratio is sitting at 4.60, which is incredible, and it's probably one of the best balance sheets that we have, guys. So to summarize, guys, I think Facebook is a quality company. Again, they have a lot of future growth. My only main concern is that their only stream of revenue is heavily dependent on advertising, and I am a bit concerned because Amazon and Google especially are picking up a market share of advertising. Facebook really need to diversify their revenue, or they're going to see their earnings take a huge hit in the next 10 to 15 years. Okay, guys, I hope you enjoyed the analysis of these three stocks. Now you know the criteria for determining a stock's fair value using the Peter Lynch method. Apply this method in your own research for stocks, guys. And if you do find any stocks that meet this criteria, suggest them in the comments below, and let's just get the conversation started. Lastly, guys, if you found this video valuable, smash the like button. And if you want to see more from me, then come on board, hit the subscribe button. Thank you so much for watching, guys, and I will see you in the next one. Peace.